It was quite a day on Wall Street. Today, something happened that has never happened in the history of U.S. trading before. And that is that one single company lost over $250 billion of market cap in a single day. And yes, the honor goes to Facebook/Meta. An ugly day for the social media pioneer. But the good news is we did hear from Amazon after the bell tonight, and it's possible that the stock market does rebound back a little bit tomorrow. But without a doubt, it was an ugly day here today. We actually saw more than 80% of constituents within the S&P 500 close in the red here today. So we're going to talk about that and see what it means for our posture and our expectations going forward. Also wanted to have some time spent on sectors and showing you the difference between a market cap weighted sector and an equal weighted sector, especially when it comes to the communication sector here today. And then last but not least, I wanted to show you a bearish trade example where you can make money if a stock goes lower through an options technique known as a long put vertical spread. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's February 3rd, 2022. First of all, if you're new, welcome aboard. Remember to go down below the video into the description area and make sure you're signed up for our email distribution list. That way you can be notified whenever we post these videos. In addition to that, at the bottom of those emails, you'll find the overbought and oversold cluster signals within the S&P 500. On Tuesday, when I last did the video, there were 0 oversold cluster signals. I have a feeling that today that will not be the case with as much selling as we saw today. I'm sure there's plenty of stocks with oversold signals, so make sure you're checking that out as well. Also, we're heavy users of Twitter. My handle is @BrandonVanZ. I would encourage you to follow me if you're not doing so already. And we really appreciate those of you that click like and retweet on these Market Outlook related tweets. And then last but not least, we do have a presence on Facebook. Of course, Facebook being very much in the news here today, but we do have a group over there. And feel free to go and join our group at that web address you see in the logo in front of you. All right, let's go ahead and jump into today's trade activity. Let's play a little bit of red light, green light here as we bring up our S&P 500 heat map. And as you can see, it was a sea of red here today, largely because of this right here in the middle. Meta platforms absolutely got decimated here today. Of course, this is the old Facebook for those of you that are having a harder time keeping up with the new name as I am. It's going to be a struggle, I have a feeling, for me to keep saying Meta in the future as opposed to Facebook. But the ticker symbol for now is still FB. They will likely be changing that here in the next month or two. But for now, just be aware that ticker symbol FB had a heck of a fumble here today. And lost about a quarter of its value, which is just remarkable. In fact, it was the worst one-day lopping off of market cap in the history of the stock market. There was $250 billion that evaporated into thin air in one single day off of Facebook's market cap, which is just truly remarkable there. So that set the tone for the entire day. I think a lot of people knew going into today's session that it was going to be a difficult one because as soon as Meta reported last night after hours, the future started tanking immediately. And today was that follow-through, and it is, as expected, it did have a bad impact across the board. You can see that there was very few patches of green here at all. We had a few of your classic examples of kind of safety trades like Procter & Gamble, that was up about 1%. Walmart was up just a touch. Coca-Cola was up 0.7%. Hershey's actually had a pretty good day. In fact, Hershey's hit an all-time high. How about that? A lot of stocks struggling, in many cases down 50% from their highs. Hershey's, good old dividend growth investing type of a company, just goes about its business quietly and is now sitting at all-time highs, up 2.7% today off of their earnings announcement. You did see some healthcare stocks doing reasonably well today as well. You can see United Healthcare was up nearly 2%. Some of you saw me tweeting about AbbVie earlier today. It was up 1.5%, and it hit its own all-time record high here today as well as another one of those dividend aristocrat types of companies. So there were a couple of little, green patches here and there. T-Mobile, by the way, was, I believe, the biggest performer in the S&P 500 today. It was up 10%, but otherwise those were few and far between. This was a day that definitely was dominated by the bears. You can see a big bright red patch up here with Amazon. and it was down 7% in the normal market session. But for those of you that haven't heard yet, Amazon did report their earnings after hours tonight and had spectacular success. They were up like, I don't know, 15 to 20% or something like that. So the amount of massive movements in the mega cap stocks has been rather astonishing lately. Of course, we talked about PayPal a couple of days ago, and then, you know, not to be outdone, but we had some other big movers within the social media space. So, you know, earlier today, Snapchat and Pinterest were down significantly in sympathy with Facebook's numbers. But after hours tonight, Snap and Pins both erupted higher. And so it's been a wild, wild session. We did have a couple of stocks report earnings tonight where the stocks were lower, including Ford and including Clorox. And like I mentioned on Twitter here just a moment ago, Clorox now has a 3% yield after hours. Clorox is not only a dividend aristocrat, but of course is one of those poster children of the COVID era, as we all recall all of those Clorox wipes being basically sold out for months on end when COVID first started hitting. But now you're starting to see the flip side of that, where maybe the demand isn't quite as strong. Clorox at a 3% yield. That's the first time since July of 2018 that it's had a 3% yield. We'll see if it holds, and if it falls even further into next week, don't be surprised at all if I end up bringing that to your attention as a sold put opportunity. Usually Clorox with a yield of about 3.2%, according to my dividend stair-step chart, has been a time when a long-term investor has felt a bit more comfortable establishing a position. So it might very well set us up for a good opportunity with Clorox next week as a sold put opportunity. So stay on the lookout for that possibility there. All right, let's go ahead and pop on over here to the main part of the platform now. And let's continue our conversation about market breadth here today. You can see that in the Market Watch visualize area of the Thinkorswim platform. I've pulled up the S&P 500 here as well. And you can see that there were only 92 stocks out of 500 that were up or finished in the green here today. There were 412 that finished underwater there. So this was a pretty big washout type of a day. Now keep in mind context here, we've just had a heck of a rally for the last 3 or 4 days, so we're giving back quite a few of those gains here, again largely because of Facebook/Meta, but at least that helps us absorb this perhaps a little bit better, knowing that there were some built-in gains here more recently. Still not a fun day, don't get me wrong, but at least it wasn't like at the end of a cascading sell-off type of a week like we had a couple of weeks ago. So we'll see what tomorrow brings, but right now in the after hours, we are trading up fairly significantly as a result of the big earnings blowout number there from Amazon. So just like Facebook took the entire stock market down yesterday afternoon after they announced their numbers, Amazon is having kind of the opposite effect tonight. I wouldn't expect the markets to be up tomorrow as much as they were down today, but there's a pretty good chance at this moment in time at least that we were up at least 1% tomorrow. So we'll see if that holds true or not. But today was one of those 80% downside types of days where over 80% of the constituents within the S&P 500 closed in the red. Let's also take a look at this chart here. This is chart 6D for those of you that are following along at home as premium members of Market Scholars. And I like to bring up this chart when we have a move of at least 1%. Well, wouldn't you know, today was not just a 1% move. Today was a 2% move for the S&P 500, 2% plus. And this kind of really puts that into perspective. Sometimes when you're looking at just the chart and you look at like that candle that I'm circling up here at the top, it's not really giving you a true understanding of whether that's a big move or not. Down below here in the middle, it can tell you that while that might not look like a big deal up there, it most certainly is, because this red line that we see right here has drifted all the way down below this orange horizontal line where it says -2. And you can see the label up here. It also says the orange line represents a 2% price move. So when that red bar crosses the orange line on the downside, it means that it's more than a 2% move lower. When the green bar crosses the orange line on the upside, it means it's more than a 2% move higher. Anyway, as you can see, today was no walk in the park. This was actually the worst day that we've had in the S&P 500 since going all the way back here to February 25th of last year. In other words, almost an entire year ago. So this was a big time day. It could have been even worse, of course, if there were a lot more, meltdowns of the small and mid-cap types of companies out there. But remember, a big reason why this candle is so aggressive here is because of Facebook specifically. Remember, the S&P 500 is a market cap weighted index, and so we've had plenty of other kind of 80% down days like we saw today that didn't result in such a nasty red bar like this. The reason is Facebook. When you lose $250 billion of market cap within a market cap weighted index, it's going to have an outsized effect. So again, I expect a snapback rally tomorrow based on what I see right now with Amazon after hours, but will we get back above where we were trading just yesterday afternoon? I'm thinking right now that's probably not likely. We're probably going to fall a little bit short of that, would be my guess. Also, note down below that this purple line represents the VIX. And you will see that the VIX did pop today. Remember, that's oftentimes the case as well. The VIX is typically inversely correlated to the S&P 500. So when you have a big down day in stocks, the VIX usually goes up and vice versa. So today was one of those days where the VIX did go up and it ended at about 25. Now keep in mind, we were trading up here at about 35 last week. So that was in the midst of that, kind of 4 or 5 out of 6 day rally that, or not rally, but drop that we had during that era there. So kind of at the worst of that selling there, VIX got to about 35 when the market started recovering last week. And then into early this week, the VIX started to fall and got down here to as low as about 21, and now has risen back to 25 once again as fear is being injected into the system. And same thing there with the markets expected to be up tomorrow. I would expect the VIX to fall just a little bit. Doubt it'll fall below 20. Personally, I think it'll stay above 20 but below 25 tomorrow. It's still a little bit of an elevated volatility environment compared to what we had experienced for much of 2021. And I think you need to kind of get used to that. I think 2022 will be a more volatile year than 2021. So it's entirely possible that our normal VIX range this year could very well be between 20 and 25, and that has not been the case in recent years. All right, let's go ahead and now get into our normal 4-grid analysis, starting with chart 4B here. And you can see that these charts kind of share some similar properties, which is all 4 of them had a pretty big sell-off day today, and all 4 of them appear to be bouncing down and away from their falling 30-day moving averages. Remember when I was last with you on Tuesday, I said that the postures from the market forecast perspective went back to weekly bullish on most of these trades, but I said I'm not convinced that we're out of the woods yet because of the falling 30-day moving averages. And I said that I don't just expect the sellers to have gone away. It's usually not that easy. So here they are. They're reasserting themselves here today. And these are not great looks for the charts. Thankfully, knowing what I know about the after hours activity tonight, I feel maybe a little bit better about the situation, but still, if you were to kind of just eliminate the after hours activity tonight and only look at these charts for what they are showing you right now, these are not good looking chart setups, right? We are seeing kind of that reflex rally, the dead cat bounce off of those oversold cluster signals back up to a resistance area. And the first chance that it got on the S&P 500, that resistance area rejected that price action back lower. So it wasn't violent enough to change the posture back to bearish quite yet. But remember, if we got a couple more of these days, it wouldn't really take much in that regard. Again, thankfully, with Amazon kind of bailing everybody out this afternoon, maybe we can delay that possibility. But my mindset toward this market remains the same, which is we were due for a rally, which we received. I was hoping the rally might last a little bit longer. Maybe it will. Maybe tomorrow kickstart another maybe week or so of a rally. I don't know. But I do still have the same expectations that it is going to be a struggle for this market to sustain itself above its moving averages, and I'm not expecting this market to go right back to new all-time highs in the short term. Perhaps this summer we can get back there, but I think this spring is going to be a little bit more give and go. I hope I'm wrong on that, because obviously I'm much more invested in the market than not, but it's just that my mindset and my expectations are that we're going to have some choppier trading here as we start off 2022. And so, this could very well be a market where we transition from buying the dips into selling the rips. And, this could have very well been an interesting day to do that with this rollover effect. Some of you may recall that we used to use a term over at Invest Tools or TD Ameritrade that was kind of the opposite of hold. So sometimes you might hear David and I talk about hold, which is close above the high of the low day. There's the opposite of that as well, which is a little bit harder to spit out because it doesn't have enough vowels. But the idea is a close below the low of the high day. And if you look at all four of these charts, that's exactly what you had. If you recognized yesterday as the high day in the most recent move, today you close below yesterday's low. And that's generally a more bearish feature there as well. So, I know that the postures say that we're weakly bullish. You got to respect that. But I think that these charts could use a lot of work, to put it kindly. They still look more bearish than bullish to me. And so I think you need to trade accordingly. Do your best to work on capital preservation. Maybe mix in a few bearish trades here or there. I did do a bearish trade for tonight's trade application. We'll talk about that later. And then, maybe you can even do some more neutral stuff like I did with you guys on Tuesday with the Boeing Iron Condor trade, right? Kind of in anticipation of, hey, a big chunk of that bullishness and that bullish move has now been made. Now you're starting to think on the flip side of the coin. You're starting to think about neutral trades. You're starting to think about bearish trades, right? Some of your best bullish trades have already made their moves. And you just have to learn to be maybe a little bit more agile in this type of a market environment if you want to be a short-term trader. Obviously, if you're a longer-term investor, that's a different story. And if that's the case, of course, I would invite you to join me in my Tuesday dividend growth investing class, where we think about those opportunities from a different perspective, where we're looking for stocks that have maybe gotten bombed out that still represent quality businesses that we want to purchase at attractive prices. But obviously, this particular video here with the market outlook tends to cater to more of an active set. And so for those of you that are active, you got to put on that active hat. And right now, you're seeing kind of that rolling over underneath the falling 30-day moving average, which is the same thing that I mentioned here, on Tuesday and last week that I had feared. And now we are seeing that kind of play out. Again, tomorrow's a big day. So, you always got to keep an open mind towards these things. Who knows? Maybe Amazon saves the world, and we're right back above those moving averages with the blink of an eye. But right now, I think I'm still kind of steering myself with the expectations that there's going to be some more difficult trading right here directly in front of us. So as we go through these, be aware that the S&P 500 was down 2.44% here today. It still has the red moving average telling us prices below a falling moving average. Yesterday, it briefly had a rising moving average for just one day, but with the sell-off today, that immediately started to move that moving average lower again. It was somewhat similar on the Dow Jones, except for the Dow Jones actually had 2 days in a row where it had a moving average that was moving higher. Again, I know that's probably pretty hard for you to see with the naked eye, so we have to trust the metrics, and it is accurate. So we haven't seen any instances where the think script is wrong in a situation like that. But I was kind of pointing that out on Tuesday when I was with you, because remember that day the Dow was the only one of these 4 charts that had a yellow moving average. At that time, the moving average was still red on the S&P 500. And I was saying that was one way for us to identify that the quote-unquote leader of this market right now is the Dow Jones Industrial Average. Now, I can take that a step further here today. While you do have the moving average starting to bend lower again, which you don't necessarily appreciate seeing, you will see that the background color changed from this light green to a darker green. And what that signifies is that this green intermediate line down below in the market forecast indicator has now crossed above the chart's 50th percentile. And so that's yet another way to sense or judge various charts to determine who the leader is. And so I remain steadfast, as I have been for the last month or two, when I say that of these four broad market indices, it is the Dow Jones that is our leader here on a relative basis. The problem, of course, is even its chart does not look great. But if you're trying to kind of do your best and you don't like taking bearish trades, then it is those kind of blue chip, dividend-focused stocks of the Dow Jones that are holding up better than the growth-oriented and speculative areas of this market. Down below here, you will see that the Nasdaq really took it on the chin today. Now, again, not a surprise there, knowing how important Facebook is to the Nasdaq composite. Remember, the Nasdaq composite is also a market cap weighted index, just like the S&P 500 is. And so it was down 3.74% today. That was a huge day. In fact, it'd be kind of interesting. I'm curious about this myself. My bet would be that this is probably the worst day for the Nasdaq composite over the past year. I don't know that to be a fact, so let's just check it here. I'm going to go back to 6D briefly. And yeah, that was the case. So my hunch was correct there. You'll notice that on this red candle here, where I've typed in $comp for the Nasdaq composite, that does stretch down and below this date back here, back in late February. So remember what I'd mentioned before, that the S&P 500 today was not down quite as much as it was back there in late February of last year. But the Nasdaq is different. The Nasdaq got hit even worse than the typical stock today because of Facebook's representation there. So this is actually the worst day of the entire last year for the Nasdaq composite, if you can believe it. It may not feel as nerve-wracking because I think there were a lot of days right in here where things felt really ugly for people because it was like a beatdown day after day after day after day. This probably didn't feel quite as bad here today because we just had a 4-day rally. And so that just kind of brings us back in the middle of that 4-day rally there. But be aware, today was actually the worst day for the Nasdaq composite in the entire last year. You probably have to go back pretty long ways, maybe back to the spring of 2020, since you saw a day like this in the Nasdaq. Let me just check that. I'm going to come in here to the time frame, and let's go back on a 2-year daily chart here. And it looks like it would have taken us back to, I believe, this candle over here, if I'm eyeballing it correctly. So it didn't take us back all the way to March of 2020, but it did take us back to September of 2020. On that day, the Nasdaq was down 4.11%. So nothing nearly as dramatic as what we experienced about 2 years ago in that wipeout in the coronavirus era, but still one of the worst days for the Nasdaq within, let's call it, the last year and a half. So pretty ugly day there, all things considered. Anyway, it was down significantly, but similar to the S&P 500, it still retains its weekly bullish posture. Like the S&P 500, it also has a red moving average, telling us that price is below its falling moving average. And then last but not least, we have the Russell 2000. Pretty ugly day for it as well. Surprisingly, the Russell actually held up a little bit better than the S&P 500, but it did not hold up as well as the Dow Jones Industrial Average. So Russell 2000, remember, does not contain Facebook because it was a $1 trillion company prior to this week. And so, of course, it's not going to be in the Russell 2000. So the damage that Facebook did to S&P 500 and Nasdaq Composite was not present there in the Russell 2000. Nonetheless, a pretty bad day for the small caps, just in sympathy of Facebook, even if it didn't have a direct impact there. So it was down 1.9%. So again, Dow Jones was the leader today and continues to be a leader from an intermediate perspective. And then you can kind of say it's a toss-up between Nasdaq Composite and Russell 2000 as to who our laggard is right now. All right, let me go ahead and pop on over here to the internet. I always like to get a chance to say thank you to those of you that help support the Market Outlook video. We always ask that if you want to thank us, to simply click like for us there on Twitter. That goes a long way for us. Anytime I'm up and over 100 likes on Twitter, I'm happy to give you a full-length video here, including a trade application example. Anytime we're under 100 likes, then I would just give you a quick hitter video, a quick little 15-minute video that's only on the indices with no trade application example. So you guys just barely got over that this past time around. The time before that was much better at 115 likes. This time only 101 of you did it. But hey, we're over 100, so here we are with a full-length video for you. So thank you to the 101 of you that stepped up. If you commit to doing that every single day, there's a better chance that you're going to have that opportunity to see these full-length videos. So thank you to Deborah and Henry and John and Vicky and Marita and Nick and Jimmy and Camden and Valerie and Paul and Kirk and Jayesh and Irene and Margie and Dave and Gerald and Roger, Ray, Bob, Surendhar, Jim, Dave, Easy, Dave, Rick, Austin, Ken, Sonia, Chris. The list goes on and on and on. I can't say hi to all of you, but just know that your likes are not going into a black hole somewhere. I do see them. They are meaningful to us, and they do help us get the word out about our business. So your efforts are definitely recognized and appreciated. Thank you very much. Please keep that up on your end as well. Also, I posted the factor selector here on Tuesday, so this is a couple of days stale right now, but generally gives us a good idea as far as any factor rotation that may or may not be taking place. We didn't see a whole lot of change week over week this time around. We continue to see dividend yield as the leading factor, retaining more strength than other factors, and we continue to see momentum as the dead last position right there. Now remember what I'd mentioned to you guys on Tuesday, which is the information technology sector was dead last on the sector selector for the first time in over 4 years. Momentum, of course, oftentimes has a lot of tech stocks within it, and so maybe that would have been a precursor of sorts that technology was on the outs as we saw momentum fall into last place here all the way back on the final week of December. So it's we're going on well over a month at this point of recognizing that momentum or the idea of price chasing is not working right now. This is not a great trend trading environment. You got to be either more nimble as a swing trader or you got to be thinking about long-term investing with dividend stocks. But trend trading has been struggling for the most part. There's always exceptions to the rule, but the category on the whole is struggling right now. So other than that, the only changes that we saw were in the 4 or 5 position where quality did go up and low size went down. Part of the reason behind that may be because Apple reported their earnings last week, and remember there was a positive response to their earnings, and Apple would most certainly be part of that quality group there. So maybe a little bit of a positive impact on that. Also, earlier today I did post our dividend growth investing blog post for the dividend increases from last month or January of 2022. So pretty fresh here, just 3 days removed. So I usually wait until the end of the month and then gather up all the data of all the companies that raised their dividends, as long as they had a previous streak of at least 5 years. So I can't do all of them, but in this case there were 79 companies that increased their dividend in the month of January. Remember, this is one of the few areas of our website that is not behind a paywall. So for those of you that are watching this video for free on YouTube right now, you are welcome to check that out. And in order to find that on our website, sometimes you can find it over here under the popular recent posts. You can see that post is available right there. And then if you can't find it there, you could always come up here to the top of our website, hover over blog, and then go to dividend growth investing, and then it should be the first posts that you see there. But quite a few well-known and well-regarded companies that did raise their dividends last month, including, like Con Ed would be an example from the Dividend Aristocrat list. Fastenal is a company that we've bought a few times over the years in my dividend classes. They had some pretty good dividend growth there. Tractor Supply had an unbelievable dividend growth of 77% last month. Polaris is a well-known consumer company. Kimberly-Clark, of course, a big dividend aristocrat type of a company. Intel, well-known semiconductor company, Church and Dwight and Cincinnati Financial, both dividend aristocrat companies. Comcast, obviously a well-known communication stock. So anyway, feel free to check that out on our website if you're interested in which companies have been raising dividends lately and by how much and what their streaks are, right? Some of these, like Cincinnati Financial, you probably don't think of them as a blue chip type of a company. They're somewhat of a quiet insurance company, but they've actually raised their dividend for 62 years in a row, which is quite extraordinary when you think about it. So check that out on our website when you get some time. Also, today I taught my question and answer session for my premium members. And so if you didn't get a chance to check that out live, here are some of the topics that we discussed. We discussed 3M and whether it's worth buying more shares of 3M. We also had a question about Comcast. We also had a question about, what if you have a lump sum of money that you want to invest in dividend growth investing? How do you go about that process all at once or kind of legging in? We had a question about Caterpillar and trying to check out their profit margins on Value Line. We had a question about how to get some folks involved in our premium forums on our website. We had a question about VF Corp and the sold put trade that we had done there and how to think about whether it's an actual winner or a loser. We had a question about the pros and cons of always using just 100 shares and keeping things simple when you're placing trades. We had a question about what would you buy if you had a certain amount set aside for your son or your daughter in terms of what stocks, bonds, options, etc. And then we had a question about what my thoughts are on master limited partnerships. So anyway, if any of those topics seem of interest to you and you're a premium member of Market Scholars, that recording has now been posted. You're welcome to check that out. And of course, all these are timestamped, so you can go directly to the question that you have an interest in. Also, David taught his portfolio management with ETFs class today. So if you didn't catch that, make sure you check out the recording there as well. All right, let's go ahead and get back on track here with some more charting analysis over on the Thinkorswim platform. And let's do some 12 grid analysis now, starting with chart 5A. Remember, this first set of 12 grids is going to be our asset class 12 grid, telling us things not just in the stock market, but sometimes in the commodity world or interest rates or what have you. So let's go ahead and get started with that analysis. And let's go ahead and get started with the lower right-hand corner. You'll notice that we have two green charts that are bright green on the board. The charts up at the top are kind of that lighter green. And remember, the lighter green signifies weakly bullish posture, not strongly bullish posture. So these two in the lower right-hand corner are strongly bullish postures, and that should make sense when you look at those four charts up at the top and then compare them to the two charts in the lower right-hand corner. It should be quite obvious to you that the two charts in the lower right-hand corner are much more strongly trending to the upside. So oil had another fantastic day. It's kind of, I feel like a broken record there. It seems like they always have a fantastic day, right? If you look at this this move since the lows here in the beginning of December, oil has just persistently gone up. It feels like every day. Of course, that's not the case, but it seems like it's 2 steps forward, 1 step back for oil. And today was one of those 2-step forward types of days. Oil was up 1.58%. So again, stressing what I had mentioned to you guys on Tuesday's video in the sector section of our conversation, where it's really just energy and everybody else is kind of vying for second place. Energy is all alone by a long shot in first place, mostly because of what is happening here with oil itself. You can see here that the 10-year Treasury had a pretty big day. Notice that interest rates did rise here today, and we ended at 1.82% on the 10-year. Now remember, when interest rates go up, typically bonds go down in price, and that is what we see here with TLT. Again, we've got an open trade on TLT right now, a bull put spread. And in that particular trade, I need TLT to stay above 139 between now and the middle of February. So we still got a couple of weeks to go, and we're kind of in that precarious area here. As I mentioned to you guys on Tuesday, that it is possible that this chart could end up breaking down more. So for those of you that are worried about that, you do have the opportunity to get out of your trade at basically break even right now. But I think I'm going to let the dice roll a little bit and let this play out a bit more. Remember, all else being equal, when you are selling put spreads or really selling anything in the options world, you're benefiting from time decay. So all else being equal, unless you are convinced that there's going to be directional nature in that chart, you're oftentimes better served by doing nothing. I know that sounds probably pretty peculiar because you probably assume that doing something is better than doing nothing in the world. But in this case, oftentimes doing nothing is better when you're the seller of premium because you're making money off of time decay. Now, obviously, if the stock moves, or in this case, the ETF moves too far to the downside, the negative delta effects will offset any positive benefits from theta. But if the stock just goes sideways or up, you're in better shape there in that case. So I'm going to let it play out at least for a little bit longer. Remember to keep your eye on the Telegram app if you're a premium member, if I do decide to shut down trades like that early. But for right now, it's still on, even though things aren't looking so rosy here for TLT. It was down again today. It remains a couple of bucks above my important sold strike there, but today it was down 0.78%, and it does continue to have a strongly bearish posture and is trading below a falling 30-day moving average. So all else being equal, we assume there is continual selling pressure on long-term treasuries, which means there's continual buying pressure on interest rates themselves. You'll notice here, high-yield bonds had a pretty ugly day considering oil was up as nicely as it was. High-yield bonds were down 0.9%, so that's a little bit of a deviation from what we had been seeing. You'll also notice that foreign bonds were not a good place to be hiding out either. Foreign bonds actually broke to multi-month lows today. Foreign bonds were down 0.64%. So whether you were trying to buy bonds or stocks today, you were likely not overly pleased with the outcome. If you were buying commodities today, that might have been a different story with oil going up nicely. Gold pretty much held the line. Notice this long lower shadow on GLD. That was kind of impressive there. It tells you that the bulls were able to buy up the shares throughout the day, and while they didn't quite get back to yesterday's closing prices, they were way off of the day's lows and nearly got back to that break-even line there. The dollar had a heck of a breakdown here. Remember, the last time I was with you was on that candle right there, and we were wondering, okay, is it going to hold above that rising moving average? My thought at that time is that it would. Well, that's the good thing about looking at charts every day. It has that opportunity to prove you wrong regularly. And in this case, my assumption would have been proven wrong. As you can see, the US dollar has continued to break down here. In fact, it's been so violent that take a look at the moving average. Now the moving average is rolling over. And we just had what appeared to be a breakout to the upside. And boy, that would have been a tough one to get pinched with if you'd have been buying the dollar based upon the breakout above that resistance area there. Just the very next day it topped out and you've been down 5 days in a row. And remember, a lot of people when they're playing the dollar, they're not just buying UUP. This thing hardly moves in comparison to the highly leveraged bets that you might be making in the actual currency market. So I have a feeling there are some people that are playing the currency markets right now with actual currency pairs that just got chopped up and spit out here in the last couple of weeks with the dollar. So right now we're down below a falling 30-day moving average there, and I don't necessarily mind that. Remember what I've mentioned to you guys in the past, which is from my own perspective, I prefer it when the US dollar is weak. I know you should be a patriot and want a strong dollar and all that kind of stuff. Don't get me wrong. I'm as much of a patriot as anybody else, but I'm also a capitalist. And the way that it typically shakes out is the stocks that I tend to be interested in actually do better when the dollar is weak. So we'll see if that keeps up or not. But it has been a rather spectacular 5-day move lower there in the dollar, and it's been one that has caught me by surprise personally. All right, let's go ahead and take a look now at our Sector 12 grid. And that will be chart 5C for those of you following along at home. Things look a little bit better here. Now remember, that shouldn't be entirely surprising. When we looked at our 4 grid here earlier in the presentation, remember all 4 of our major U.S. equity indices still had a bullish posture. I wasn't particularly enthusiastic about the trends, but their posture, according to the market forecast and how you would read that, was bullish. So it makes sense that if all of the major U.S. equity indices at a high level have bullish postures, then most of the sectors at that next level below it should also be bullish. And that is the case, as you can see here. But I think most of these charts have a lot of work to do. And I don't know how much I trust the vast majority of these charts, quite frankly. frankly. So again, you can see energy continues to be a leader. Now, surprisingly, it was down today. I didn't catch that previously, but now I can recognize that with my eye. And I say surprisingly because remember, a barrel of oil went up in value today. Typically, when that's the case, you get kind of a leveraged upside in the entities that are pulling the oil out of the ground. We had a good conversation today in my class about midstream energy and those that are transporting, fossil fuels via pipeline. But a lot of the profits that you will make in the energy business are from the explorers and producers. Exploration and production is another way to say that. Those are your bigger players. Of course, you have your vertical energy models as well with companies like Exxon and Chevron. But within that vertical model, it is the exploration and production division that earns the profits at a much bigger level than the other divisions. And so typically what you find is that when oil prices go up, energy companies on the whole do reasonably well. So perhaps this is just a little bit of profit taking here because energy had been doing so well for such a long period of time that there's an opportunity to take some profits, and maybe that was used as a source of funds to fund some other investments that had gone down a lot today, like Facebook or others. Don't know, but it is a little bit odd to see that type of behavior. Nonetheless, this is obviously remains a very, very strong trend. You can see that today we have a couple of other charts that do have strongly bullish postures. That was not the case on Tuesday. Remember, on Tuesday, energy was the only one that had this dark green background. Today, we now see financials and staples also having that dark green background. Of those two, I do tend to prefer the staples chart. Now, remember what I'd mentioned about Clorox earlier. They're getting whacked after hours tonight. They're down like 7 or 8%. Clorox is one of the more important staples companies out there, so it is possible that it has a negative impact on the staples tomorrow as a result. But if I were just to look at this chart and then compare it to the financials up here, I do think that the trend of staples is still doing quite a bit better. In fact, kind of interesting, staples were actually up today, right? Going back to what I'd showed you during the heat map portion of the presentation. Remember, Procter & Gamble and Coca-Cola were up today as two examples from the staples space. So again, this is an example that this was a market that was living in fear here today, and it was trying to hunker down where it perceives safety. And a lot of times it's those big lumbering giants, your blue chip dividend growth types of companies like your Procters and your Coca-Colas that tend to hold up a bit better. So they weren't up by much, but they just skirted by with a 0.03% increase here today. That was the only sector that did close in the green. All 10 other sectors were easily in the red, and no surprise, it was communications that was by far and away the worst. They were down 6.69% there. That is just a bloodbath for an entire sector. And again, that's because XLC is market cap weighted, and therefore Facebook is going to have a much greater impact on it. I would venture to guess that if we look at communications from an equal weighted basis, it's not down 6.69%. Remember, we can do that. If you're a premium member of Market Scholars, I have a chart here in the one category that I use for my top-down trend trading class called equal weight sectors here. It's chart 1G. So again, remember that number I just gave you a second ago of minus 6.69%. And now let's compare the equal weighted version, and it wasn't even remotely close. Look at the communication sector up here. It was only down 1.33%. That is one of the biggest discrepancies I've ever seen between a sector from an equal weighted approach versus a market cap weighted approach. And again, it goes back to the fact that Facebook was one of the most important stocks in the market from a market cap perspective. So if you were in just your typical communication services company today, like a Verizon or something like that, you're probably wondering how in the world was the communication sector down 6% today? And it can be placed squarely on the back of Facebook there. So typical communication stocks today were not down nearly that much, but the bigger players were, and therefore it had an outsized impact. All right, let's go ahead and get into our trade application example now. And as I mentioned earlier, I actually did a bearish trade here today. So let me go ahead and get out chart 3A to show you what I did. Hang on just a second as it gets loaded up here. And the ticker symbol is DHR. This is Danaher. And Danaher has been a very successful business over the years. If you look at their long-term chart, it's rather impressive. It's a quiet company you don't hear a lot about, but they've done tremendous things for shareholders over the past decade. They seem to have hit a little bit of a rough patch here more recently, though. And I was trying to find companies here at the end of the trading session today that had gone up towards their falling 30-day moving average and then appeared to be kind of rolling over to a degree. It was a little bit harder to do that than you might imagine. There were a lot of companies that had this kind of shape about it, but most companies were not near their 30-day moving average yet. A lot of them fell well short of it. At least this one got generally pretty close to that moving average there, where the mindset, I guess, could be the same. Now, keep in mind context here of the conversation I shared with you on Tuesday, which is I shared with you that day that pretty much all of our trades up until that day were bullish that I had presented to you over the last month. Remember, they were all profitable as well. One day later, that was no longer the case because Alibaba did fall yesterday, so that one's no longer profitable. But on Monday it was, or Tuesday it was. And in the weeks leading up to that 3-day rally that we saw as of Tuesday night, it ended up being a 4-day rally as of yesterday, I was doing bullish trades, not bearish ones, because I was anticipating that we'll eventually get a bounce. And it'll be a pretty sharp bounce in all likelihood because of how aggressive the selling had been. So I wanted to kind of fade that aggressive selling by doing bullish things, and that's why I put myself into that position to benefit when we ultimately did get the rally. Now, I did do one bearish trade along the way, which was that Charter Communications short sale that did close at max profit. So that one wasn't included because it wasn't open at the time I was giving you that conversation on Tuesday. But remember, on Tuesday I said that's why I'm now, after we've had 3 days in a row of upside, now switching my mindset to looking for more of a neutral trade. I'm not looking for a bullish trade after the markets have gone up 3 days in a row. A big chunk of that rebound has likely already been made. And so that's where I did the Boeing was an iron condor on Tuesday. And you can see here, Boeing has done absolutely nothing for the last 2 days, including today. It was only down 0.5%. Remember, that's exactly what you want when you're selling iron condors. Anyway, I also said on Tuesday that ideally, if given the opportunity, I would like to start putting on some bearish trades again, because it is my expectation that with all of these falling 30-day moving averages all over the place, that the market will eventually roll over again. I just need that opportunity. I didn't feel like today was the ideal opportunity because I put the trade on late in the day after the market was already down. I would rather put that on with more precision. But remember, I only do these videos on Tuesdays and Thursdays. I'm not with you every single day, so sometimes I just have to, accept whatever is given to me on any random moment in time. But at least now we're going to have a bearish trade in our portfolio that we can kind of act as a balancing act of sorts versus the other trades. So remember, sometimes I view these bearish trades as what you've heard me call sacrificial lambs before. In other words, I'm willing to throw those ones out there with almost hoping that they don't work, because I know I have way more bullish trades on as well. So perhaps I'm a little bit early in this move. Again, I was a little bit surprised. I was thinking that the market would have another few days to the upside where it would get to that moving average and then roll over. Most of the markets are rolling over prior to getting to their moving average. So maybe tomorrow will be another, move up where we get closer to that moving average again. So the point that I'm trying to make is I don't necessarily consider today to have been the ideal time to be putting on a bearish trade. You might have a better setup for bearish trades here in the next week or so, but I'll of course keep my eye open to that opportunity there as well. But for today, what I opted to do here in the case of Danaher is what's known as a put debit spread. It is a bearish trade, so some of you might call it a bearish put trade or a bearish put vertical. And what we usually do is we buy one put that is in the money and sell another put that is out of the money. And so in this case, with the stock trading close to 290 right now, the put that I bought was the 300 and the put that I sold was the 280. And so what I'm hoping to accomplish with this trade is for this stock to roll over down here towards 280. My best case scenario is if this stock closes below 280 on expiration day. And I think I did the March contracts for this one. Remember, if it falls below 280, if it goes all the way down to like 250 or something like that, it doesn't really matter to me. What I need is for it to get to 280. And once I'm there, I'm kind of tapping out my potential. So remember, if you were more aggressively bearish, what you would do is just simply buy a put outright. There you're not capping your potential. When I did what I did here today by buying this put spread, it is a debit spread, meaning that I had to pay money out of my pocket for it, but I didn't have to spend as much money as I would if I would have just bought the put outright. So the benefit I get by selling the 280 put is I am somewhat financing the cost of buying the 300 put there. Okay, so that's why somebody chooses to do that. But again, if you're somebody who looks at a chart and says, okay, I think this stock is going to make a massive move lower, you're probably better served just by buying the puts altogether. I rarely think in those terms because I don't assume I know where a stock is going to go. Obviously, you have to have, some sort of expectations in order to place a trade, but it's the consistency of your hit rate that matters most. And I don't really have a whole high amount of confidence that, yes, I know for certain this stock will be at this level at this time in 3 weeks, right? I don't think in those terms. I'm more of a long-term investor as a dividend growth investor. So I think really long terms. I think in terms of years and decades. So it is a little bit harder for me to say, yeah, let's get really excited about buying a put here when I know how expensive it is to buy puts. So one of the way I can kind of resolve that and justify it in my own head is that if I do buy a put, let's also sell a put against it to somewhat finance the cost of that put, and I can still have a reasonably good outcome. Remember, when we do trades like this, we do have the opportunity for a 100% return on risk, because we basically paid out of pocket a little over, I think it was like $9. It wasn't quite $10. It was somewhere between $9 and $10 to access this, which means that for a $20 wide spread like we have here between 300 and 280, that we have the opportunity to make a little bit more than we are risking, and therefore our reward possibility, not a guarantee and not even a likelihood. Remember, we do need this stock to roll over, but if it were to happen, then we have a very nice reward setting on the other side of that trade for us, where we could make 100% on our risk here. Remember, that is different than a lot of the other bearish trades that I might show you, known as selling bear call spreads. There you have a higher probability of success, but you are limiting your reward possibilities as a result of that. So this is kind of in the middle, where you would think about your buying the put being the most aggressive, but also being the less likely to actually succeed. And then on the flip side of that, you have selling a bear call spread, which is the highest likelihood of succeeding, but you have the lowest reward possibilities. This buying a put spread as a debit spread is kind of in the middle of those two things, where you still have a really good reward possibility of a 100% return on risk, and you also have decent odds of success. It's more of a coin flip there. And so it's one of those things where if you feel like you're reading the charts the right way, that your edge when you're doing a coin flip trade is your ability to look at a chart and evaluate it and then analyze it and then make an assumption as to where it's going to go. And as you can see here, Danaher had a very nice response after their earnings announcement here, got all the way up here close to the moving average, and then today started to sell off just a little bit. And in doing so, the background color of the chart turned to light pink, telling us that this blue near-term line had fallen out of the upper reversal zone in this case, which is considered a bit more bearish for a swing trader's perspective there. So anyway, we'll see how it goes. Remember, you do have to babysit these trades a little bit more, which is one thing I don't really like too much about them, because I'm a busy guy, busy business owner, teaching my own classes and all this kind of stuff. So I don't always like to babysit my market outlook trades. But this is one where you kind of have to do that a bit more. Remember, when you're selling bear call spreads, you don't really have to babysit those trades all that much, because they have defined risk, and a lot of times they'll just expire worthless, which is a 100% max gain for you. In this trade, you have to be a little bit more careful come expiration date, because if the stock is trading between 300 and 280 and you forget about it, you might end up having a short position of 100 shares for every contract that you traded in your portfolio that Monday after expiration weekend. So you do have to babysit these trades a bit more and get out of them along the way. Otherwise, you do run the risk of that situation happening. So maybe not a good trade for a beginner out there, but hopefully if you are a beginner, you start to piece these different things together as to when you want to be more aggressive, when it may not be worthwhile being aggressive, and how you would kind of choose a trading strategy to implement around what your philosophy was on that particular chart. Okay, so that's what I had for you here tonight. As always, if you got value out of tonight's video, I ask one simple thing from you. I just want to trade 5 seconds of your time for the 3 hours of my time that it takes to put together these videos. And all you have to do is click like for me there on Twitter. Nice and easy. There's 4 different ways to go about that, by the way. I showed you on my Twitter feed itself that the tweet in question will be pinned to the top of my timeline. So if you're always on Twitter, that's going to be your easiest way to do it. Otherwise, if you're watching the video on our website at marketscholars.com, remember we have those little Twitter embedded widgets directly below the video where you can click the heart sign there as well. And then we also have the tweet in question will be in the description area for those of you that watch directly on YouTube. And then we also have the tweet in question kind of hyperlinked in the Twitter logo in the emails that we send you guys as well. So those 4 different ways will get you to the same place. However you choose to do it, I'll let that be up to you and however it's easiest. But that is your way to help us get the word out about our business and helps us justify the amount of time we spend for free doing these videos here. As long as we're up and over 100 likes by the next time I do the video on Tuesday, I'll do a full-length video, including a trade application example. If we're under 100 likes, then I'll just do a quick little 15-minute index-only video with no trade application example. Okay, so with that, I want to wish you all the best of success with your trades and your investments. Goodbye for now.